Okay, folks, welcome back. This is price action model number 11. This is a day trading model, and it's going to be specifically dealing with stalking setups that provide a potential of 30 pips per trade. Okay, so the ICT price action model number 11, day trading model, stalking 30 pips per trade. The stage for this model is obviously still working within the weekly range expansion. Now you're probably noticing that that's pretty much the stage for all of them, and that's the definition that promotes a high probability trade. If we're trading in that direction of that weekly range expansion, okay, and right away the question is going to be, well, how do I know what direction that is? Well, it's the same thing you see me doing on intraday charts applied to a weekly chart. It's reading price action, institutional order flow. Where's the next draw on liquidity? And what have we moved away from? If it's moved aggressively away from one level, higher or lower, you're going to be looking for opposing liquidity pools. Now that could be in the form of an internal range liquidity pool or an external range liquidity pool. This setup is going to be focusing on previous daily highs and lows. So you're going to be focusing primarily on the daily chart for your bias, your directional draw on liquidity. Okay, is the market going higher or lower? What's it reaching for? But you're going to be using that inside of the scope of the weekly range expansion. So in other words, we're looking for, when we're bearish on the weekly chart or expecting the weekly chart to go lower, we're going to be looking for old daily lows. Okay, that's going to be the draw on liquidity. That's where our target is. So preferably the market will be above that or above some previous daily low. Now it can be in the form of like equal lows or a single low. Doesn't make a difference. There's liquidity below an old low. When it's bearish on the weekly chart, the daily chart will give us our setup to frame a range expansion in the direction of the weekly chart. And we're going to be using the price pattern of internal range liquidity to target external range liquidity runs. Okay, and I'll go into that again in more detail when we get into the charts. But when the weekly range is bullish, or we expect a expansion to the upside on the weekly chart, we're going to be looking for old daily highs to be targeted for a run on liquidity. So inside of that fractal or framework, we're going to be looking for internal range liquidity to be buying, and then exiting with offset distribution at some external range liquidity that would be above an old daily high. Okay, so that's the framework of this model. Very, very simplistic. Don't overcomplicate it. What I just said is that's all there is to it. Okay, now you can increase the likelihood if you're trading inside of a seasonal tendency that would warrant that weekly range expansion. The daily highs and lows being targeted on a Monday, Tuesday, or Wednesday. And the internal range liquidity pools are going to be fair value gaps, liquidity voids, and order blocks. Okay, so you're not entering on a stop run, okay, or a turtle soup. You're actually entering once a range has started to expand. You're getting inside of a retracement of some sort. But you're going to be looking to exit as it trades outside of the range that's defined on the daily chart. Okay, so the liquidity pools that would be below an old low when bearish on a daily chart, or the liquidity pools above an old high on the daily chart when it's bullish. That's your targeted area, or where you'd be looking to take profits, or very close to it. Now, we do not require, this is the main thing here, okay, you don't require that daily high to be ran out or that daily low to be ran out to be profitable. The model itself is just 30 pips. So if you're looking for something to more or less grease your gears that gets you thinking on a low-end, low-hanging fruit model and start building up from, this is a beautiful model to work within in terms of looking for a weekly setup that doesn't require a lot of work, doesn't require a lot of study. The setups are really frequent. If you have a large basket of markets to follow, not just Forex pairs. Any asset class, you can find this set up every single week. Okay, the problem is you're going to think that you can do this every single day. And that's not what I'm trying to promote here. I want you to think about the highest probable conditions and then only executing on those. And let the lesser probability scenarios, just study those, but don't really engage those. Study them, yes, but you want to be moving towards a model that you only want to be exercising when the probabilities are highest. Okay, so as a reminder, the highest form of probability is when you're trading in that weekly range expansion. So if the weekly range is expected to go higher, we're going to be looking for buy setups, targeting daily highs, old daily highs. Now, here's the other thing. We're not trying to predict the weekly close. Okay, that's not what this is about. All we're looking for is the expansion model. We're going to capture something in the form of 30 pips inside that weekly range. So it's important that you know that we're not trying to predict. It's not necessary. It's not required. It's not a prerequisite for you to know where the weekly chart's going to close. None of that's important. We need volatility as a trader, short-term trader, intraday trader. And if we get the volatility in a direction that we've already considered beforehand, if it presents itself and allows us to take a 30 pip haul, then great. We'll harvest that 30 pips and then we'll move to the sideline. Or if you're trading a Monday, Tuesday, or Wednesday and it hits your objective, you can leave a very small portion on to see if you get any kind of follow through. So again, it's not about day trading or forcing you to be a day trader. You can use this model to trade one shot, one kill. You can trade it with short-term swing trading and position entries. It's all fractal. It's just a matter of what you want to do as a trader. I don't want you thinking that you should hold the entire position. That's what I don't want you to think. In other words, you're not going to use this model to get in, and then when it offers you 30 pips, well, I'm not going to wait for 30 pips and just get out there. I'm going to wait for my 100 pips, okay, or my 300 pips, or my swing trade. You have to pay yourself at some point, okay, in your trading. You have to make a threshold at which you fund yourself. So for some of you, it may be 20 pips. Others that are really ultra new may feel comfortable taking some profit off at 15 pips. There's nothing wrong with that. You cannot go wrong losing money, okay? If you're banking something in a demo trade, you're rewarding the trader. You're paying the trader. The analyst is rewarded when the analysis comes to fruition. The gambler is just in there for the fun and the action of what could happen. Well, we all know what could happen, train wrecks and planes fly out of the sky all the time. We're not inviting that in our trading, okay? So we want to operate in the purest sense of high probability, execute on solid entries, working within an internal range capacity, targeting external range, okay? Because we understand that the large institutions will be doing the same thing. They'll be entering some measure of retracement with the expectation the expansion will push outside the boundaries of the current range, and that's where they'll offset and be counterparties to a pool of liquidity or an opposing pool of liquidity that they entered off of. Okay, so again, weekly expansion. We're going to be identifying a likely 50 to 100 pip expansion on the weekly chart. That is the prerequisite for high probability. So if the chart on a weekly basis indicates that we could see a move higher or lower, okay, in the form of a 50 to 100 pip price run, that's the underlying characteristic, if you will, that makes this model high probability. Now, if you're looking at a weekly chart and it's trading really close to an old weekly low within 30 pips, that's not going to be high probability. Now, it doesn't mean you can't scalp that, but at least for this model, it doesn't fit the criteria. You want to be able to see there's a possible range expansion still left to be fulfilled in the form of a 50 to 100 pip. Closer to 100 pip, the better, but it doesn't need it. 50 pips is enough. And then if you allow for that, or if you see that much of a range, okay, that's still available, that moves the weekly chart higher or lower, then you have the underlying context that forms the basis of a high probability scenario. It does not mean that you will not incur losses. You're going to lose trades, okay? You're going to lose trades trading this. You're going to lose trades in live funds if you trade it. You're going to lose demo funds. You're going to lose your brains, okay, and your wits when you first try to rush into this trying to do it right away. You need to study it, okay? I introduced how we should be back testing, okay, with the fair value gap this week of this recording here. You want to be going back and looking at how this has fared over the last several weeks or months. The more examples and the more experience you have looking at how this works in hindsight, the more comfortable you're going to be when you start looking at it as a walk forward test. And again, just because you think you've seen enough examples in the past doesn't mean go in there and start demo trading it. Because again, you have to now start studying it as a paper trade. That means you're not engaging actually at all. You're studying it and say, okay, right now, price is set up to do this or that. I should run this level or this liquidity pool. And I think that it's going to trade down to this order block, or it's going to trade into this fair value gap, or come into the consequent encroachment for a liquidity void, or BISI or SIBI. One of those things, okay, you're going to gravitate towards. Okay, one PD array is going to make more sense to you relative to the present market condition and market structure. I cannot predict what PD array is going to be the right one in all situations. Okay, everything that has to be considered and analyzed at the time. And that's why there's never really this perfect cookie cutter approach and recipe that always works. It never changes. It's this. There's always going to be some underlying theme. Okay, and the underlying theme is we're looking for a run on liquidity because that's what institutions do. But between where the market is right now and where that level is, there's a myriad of different situations or scenarios that could form the basis of a trade. Not all of them I will agree with and participate in, and they still will come to fruition and go to that level. And that's fine. The maturity I've adopted in 20 plus years I've been doing this has allowed me to see that and say, okay, well, that's normal, because I can't be in part of every trade, neither can you. And some of you still may be, as a charter member, thinking that you need to have something that tells you every single move. You do. You'll all have the ability to go back and look at everything in hindsight and say, yeah, this is what that did there, and this is how this could have been used. But maybe you didn't see it at the time, and there's no shame in that. There's absolutely nothing to be worried about, because what you're expecting by looking at things like that is you're elevating this to a level of Olympic gold medal, like Michael Phelps. Okay? I mean, the guy's just over and over and over again, gold medal, gold medal. You don't need that, and you shouldn't aspire for that initially as a goal for your trading. Now, as a career, that should be your long-term goal. Yeah, absolutely. Always strive for that. Excellent. But don't force this model or any model to try to deliver the answers for all situations. Okay, there's not a panacea model. Some models are going to work very, very well in certain conditions. So just make sure that we have that very clear in our understanding about how one model is not going to answer all situations. And it's okay for the current condition in the marketplace to not be your favored market condition or market structure to trade in. Some of you that have a very hardline contrarian approach to thinking, and you're hardwired to think like that, you can focus primarily on reversal patterns and using models that would allow you to trade on a reversal situation. For instance, long-term possible reversals, okay, that may be coming to fruition. I don't personally like to do that, but some of you might actually do very, very well doing that. And I don't want to discourage that pursuit if that's where you're being drawn to, because let's just face it, I can be good at a lot of things, but I'm not a master of it all. Okay, so I want you to feel comfortable using my tools to kind of like deliver the model that you feel most comfortable with. And if we agree on the fact that not all situations are answered by one single model, one model can be utilized once you understand how fractal the market is. You can use that model for reversal scenarios if you use it in the proper context. And I'll talk about that in this teaching as well. So it's not just simply looking at the expansion in the weekly chart and trading only in that direction. When we get to a specific price level or a context that changes that narrative for the near term, then you can change gears and use the same model just in reverse. Okay, so it takes a lot of understanding and a lot of experience before we can start being that flexible with a price action model. But I want to kind of like incorporate that a little bit here, because at some point, you know, when you start looking at what I've been teaching you, there's a lot of, I feel like I heard this before. It's because you're learning, you understand it. So that's the goal in the mentorship. You want to be able to more or less anticipate what I'm going to say relating to a subject matter. And that's how you know you've learned and are learning. And once you understand what you're supposed to be doing without me mentioning it in the reviews for our weekly analysis to come, okay, that is like a graduation for yourself. I mean, you know what it is I'm looking for. You know how I'm going to engage. And that's how you know you've been successful with the mentorship, and I've been successful as your teacher. But you're going to be looking at old daily highs and lows with this model. Okay, so that's going to be the target or the draw. Okay, think of it like a magnet on price. It'll pull price to that level. So IPTA will want to reprice to these old daily highs and lows to allow institutions to offset or accumulate at that level. So we're anticipating a run on liquidity above an old daily high or below an old daily low. We're using internal range liquidity to target external range liquidity. So we're going to be utilizing internal range liquidity pools, and that is like a fair value gap, a void, a BISI, SIBI, something of that nature, where you get one single or a single pass through on price, higher or lower. It will look to rebalance that. And we're going to be using that to facilitate an entry in the direction of the weekly expansion and looking to exit on an opposing external range liquidity pool. If we're bearish, we're going to be looking for sell stops below the marketplace, because if we're short, we're going to be looking to buy back at a lower price. And we're pairing our orders with existing sell side liquidity in the form of sell stops. And the reverse is said when we're bullish. We're long to exit our position. We want to be selling it to an old high, because above that old high, there's going to be buy stops, because there's traders that are short. So we use that to pair our exits. We're selling to those willing buyers above an old high. All right, so we're going to focus on the weekly chart here. And this case study is going to be focusing on the New Zealand dollar. So this is our weekly chart here. And you can see this is the week at the time of this recording. So we're going to be analyzing and breaking down this specific weekly candle. But I want to take your attention right back over to this old low here, because this is where the external range sell side liquidity pool is resting, just below that low. Now, from the opening on this week, Sunday or midnight on Monday, it is our weekly opening price. From that price point on, we're anticipating, we're expecting, okay? We're not surprised, we're not confused, we're anticipating a movement lower on the Kiwi down to this old low. Why? The market's moved sideways. Yes, it's left equal highs. I know some of you think, well, why wouldn't it run up here and hit that? Think about what I explained in relationship to the dollar index this week past. We were expecting an upside move on dollar. So if the pair that we're looking at here is New Zealand dollar, New Zealand should go lower if the dollar is going to go higher. So you have to factor all those things in. It's not simply looking at the weekly chart and saying, okay, well, where's the next liquidity pool? We have to use the economic calendar like we do on our weekly reviews, trying to formulate a basis to what weekly template may unfold, which I don't talk too much about, but we're kind of trying to like start ringing them in, especially when we start going into the specific trading plans in 2020 for these models. If we're bearish, as the case would have been for the Kiwi here, because of our bullishness that we had for the dollar, all foreign currencies were bearish to us last week. And it's not just me cherry picking this because it works well for me for this scenario. The things I'm going to explain here, you can look at the euro dollar, you can look at the Aussie dollar, you can look at the British pound. They all did very similar things here because of our top-down approach to analysis. Working from the higher time frame weekly, we've been targeting that weekly SIBI on dollar, which is a bullish premium array. We're looking for that to be traded to. Does it need to get all the way up there? No. And we saw that happen in the form of consequent encroachment. We saw it happen in the dollar CAD pair. Okay, same thing there. So we're bullish dollar last week, and that would be, again, as a reminder, bearish for foreign currency. So again, I just want to say that because sometimes folks will be watching this video and we may be years ahead and they're just studying this now at the time of their membership, and it's probably past. Just know that the time of this recording, it's the last weekend of April, 27th of April, 2019. Just know that our weekly reviews and our analysis was calling for a higher dollar, and that would mean bearishness on here. So we're going to be looking for a 50 to 100 pip run lower. Now again, you're going to be doing this on the weekend before the market even opens up on Sunday. So right away, we do have at least 50 pips between wherever we open up. We have to see that opening price. As soon as it opens on Sunday, we know that there's a range that's still available in the form of 50 to 100 pips. So we already know we meet that minimum threshold for this model. Now, over here I have the daily chart indicating the high on Sunday and the low on Thursday. This is the actual weekly range just being delineated on a daily chart. Inside of that range, okay, what I'm internalizing, what I'm seeing and anticipating in my price study is I want to see expansions lower and then a willingness to come back and rebalance that and then trade lower again. Just like bearish order blocks provide resistance in strong institutional order flow that's bearish, the same thing is said when we have fair value gaps or SIBI that are filled and then price goes lower again. What that is indicating is the old adage of sell the rallies in bear markets, buy the dips in bull markets. But the problem is there's really no way of making that clear for a retail trader. So without looking at indicators, without looking at trend lines, moving averages, or any of that, we're reading simply the price action. Because we know that IPTA will want to rebalance at specific price points at specific times of the day on specific days of the week. Now, when you understand that, it gives you a great deal of confidence. It boosts your confidence to a level of, well, I don't really need to rush into my next trade because I know what I'm looking for, and they always repeat themselves. So it allows you to control greed. It allows you to control fear. You don't fear missing out on anything because they keep repeating. You're not greedy. You're not trying to make everything on this single trade because you know there's lots of other trades that's going to repeat just like this one or the next one. Okay, so it helps you when you have these models understood, and if you gravitate to one of them, and it may not be this model here that you gravitate to, but just know that these are just suggestions. And I'm not saying these are the only 12 I'll ever do. I'm sure in the years to come, I'll probably give you something else. But these are just really good models to work within because they're simply models that I have used and they serve me well. But when we look at the weekly range that's being shown here on the daily chart, all I've done was transpose those levels over to here on an hourly chart. Okay, so the high, and we're expecting at Sunday's opening, the expansion down to this level here, which is roughly the old daily low that we were looking at on, I'm sorry, yeah, that's the daily low, but the low that we were indicating on the weekly chart on the previous slide. When price trades down to that, okay, once we get to that level, things can change. Okay, so the narrative can change gears and we no longer are that bearish. So at that moment, this is when this model can become a contrarian model. Okay, so then once it hits that level, the weekly range could then retrace. So it's not just we're only trading the expansion down, but once it reaches terminus, or where it trades to as our objective, and it shows a willingness to want to go higher, we can trade that with a reversal mentality, okay, and trade that as a retracement. Just note that that's the advanced form of this model, and you would see this right here as a original consolidation, sell off back to the consolidation here, distribution, redistribution, smart money reversal, low risk buy, reaccumulation, and clearing the original consolidation, which is this high here. So all of this is a balanced price range, and we left it with this here so we could see that retracement back up. And that's how we would use the reversal side of this model. Looking for all these imbalances, BISI, buy-side imbalance, sell-side inefficiency, but not in the sense that they're naked and only exposed on one single candle here, because you have to frame, remember, the market maker buy model. You want to pair it up with where the market created selling opportunities over here and over here. So take that right across the curve, and we can see here we have a down closed candle. It becomes a bullish order block. Why? Because it's framed with this context over here after the turn. So the curve now is on the buy side. This is all the sell side. We're going to be focusing primarily on this teaching on the sell side, but I just want to add this in here because it seems like you can only use these models one way, but there's different scenarios and there's different conditions in the marketplace all the time. It's not just always an expansion. There is reversals, and you want to utilize that only when it gets to terminus. Okay, and then we'd anticipate. So you may not have done the low risk entry here, and you may have done the reaccumulation here, and then we have a small little fair value gap right there. Okay, price trades right at that opening, fills. You don't need that opening to get you in there. You could be right at the top of the fair value gap here, plus the spread, so that you would be here long, with the expectation we would run the original consolidation out here. And it does that. We see it again create another fair value gap right in here. Price comes down, trades into it. You could be long there with the expectation that we would run out the original consolidation. So again, it's not that we're looking for only the expansion. Okay, you can anticipate trades in a counter trend basis, but only after the terminus has been reached, or what makes that trade a model number 11 expansion trade. When it comes to its target, then you can transition if you're comfortable, or if you are a contrarian, you wait for these scenarios to unfold. Maybe you're not comfortable with trading the expansions lower. You want to trade this down here. There's nothing wrong with that. There's absolutely nothing wrong with that. So getting in a low risk entry here after smart money reversal. And again, this is an hourly chart, so you drop down a 5-minute chart. It gets a little bit more precise about where your entry would be. We don't drop down in 5 minutes on this teaching. But you could be in here, and clearly that's a 30 pip run you can get there, and that would be your setup. But using model 11 in a contrarian capacity. Okay, so I say that only to allow for completeness sake for the model, and include that same thought process when you're looking at all the previous models. Whatever makes that framework for that model come to its target, or the end or the terminus of that move or that setup, at that moment, when it reaches terminus or the end of the move that you anticipated, that's when the reversal mentality comes in. Okay, so we went from expansion, from consolidation to expansion, and then reversal. So for this model, we want to be focusing inside this weekly range. We're going to be looking for 30 pip price runs that are logical, but they have to form on the basis of an internal range liquidity. The market leaves aggressively this consolidation. So our eye goes into areas where there are SIBI, sell side imbalance, buy side inefficiency. We have one here. The market trades up into it and aggressively trades lower. we have a break in market structure here inside the range. So this low is broken here. This is not going to be a void. Okay, this is not going to be a fair value gap. It's not a SIBI because we have a break in structure right here. So IPTA will use this old low. That's the basis of the SIBI. And we'll look at that when we go in lower time frames. Then we have another level of distribution all the way down into just above the level we were aiming for, that old daily low. And then finally we swept it. And then we get the smart money reversal, low risk buy, reaccumulation, and then a run higher. Back to the original consolidation prior to this initial drop down. So all of these elements seen on the hourly chart are really, really handsome in the form of price action. It's a lovely thing to look at price and see signatures in price delivery that repeat themselves over and over and over again. And that's what's important about studying these models with a hindsight approach for a long time, because it will get you very close to reading price action because you've seen so many examples. And then looking at the 15-minute time frame, it doesn't look too much different from here. Just they thin up a lot more in areas that doesn't look so thin over here. So we're going to take a look at this in detail, moving on into our next slide. The weekly chart here. Again, this is the old low. Now this is a daily low too, but it's a weekly low that we're targeting an expansion down to. Okay, so the daily chart on the right-hand side is that individual single daily low, but it's a weekly low here for that particular week. But this is the low we're going to be targeting, and this shaded area is this single weekly candle. Now notice before I get into this that the weekly close is well off of its low, and that's okay because we mentioned on this week on Wednesday that we have seen enough of a rally on the dollar index, and I didn't feel that we would make that full run higher on the weekly SIBI to be filled in. So a consequent encroachment and the day of the week leading into Thursday. Thursday generally makes the weekly higher low in a New York session. All those factors were there that helped me feel confident in telling you that I didn't think we would see a continuation on Thursday and Friday into the dollar and then running up and filling that full weekly SIBI. Now, we ended up getting a slightly, very, very slightly modest higher high on Friday, but it was on the basis of an SMT divergence. So cable was not willing to make a lower low. Euro did with the higher high met in the dollar. So we have an SMT divergence, USDX SMT divergence between cable and dollar. And that was one of the catalysts. But after we traded into a consequent encroachment on the dollar index. So that's the reason why from Wednesday of this particular week of discussion and this week of trading, we get that slacking of the bullishness very, very short term for the dollar index, which allows buy side to be offered easily on foreign currencies. In other words, this again, I'm saying all this to remind you that we're not trying to predict the weekly close. All we're doing is trying to get the range to expand to allow for us to get 30 pips. Okay, so this weekly candle is just simply the daily chart being shaded here in this shaded box. Okay, so inside that opening on Sunday, we're going to be looking to see, okay, it opens here on Sunday, great. From that opening, do we still have 50 pips before we get to a level that would be ran out for liquidity? This is the draw on liquidity. Why would I expect it to go lower? Because there's nothing to anticipate going higher. We've already been breaking down. Bearish order blocks have been supporting price. Bearish SIBI have been filled in or traded to and an expansion lower afterwards. So everything is indicating that institutional order flow is bearish for New Zealand dollar ahead of Sunday's opening. So when we see Sunday's opening in here, right away we know that this is our eye goes right to here. So this is the draw on liquidity. Right away, we can see roughly at 66.85, okay, 65.85 is above this level. So we already know that we have 100 pips available to us. So again, high probability scenario is met. That threshold is met right away. Let's move into another perspective. The daily chart now is on the left-hand side. And again, that same range in here, that shaded area. We want to look inside that shaded area on the basis of imbalances. So we want to see the market expand lower and then return back up into an internal range liquidity pool. We see that here we have an old low here. Price breaks down through it. Okay, that's the beginning of the imbalance. And then we have this candle here that creates that short-term low. This high, do we look at that high to this low for a SIBI? No. We look at this candle's high because it opens and has a small little wick up, very small one, and then it starts to deliver down. So buy side was offered up just a little bit here. So from that candle's high and this candle's low, that is our SIBI, or sell side imbalance, buy side inefficiency. Trading to this level here, that's enough for a fill. But you have to factor in a stop that would be above this high here, because that's your swing high prior to, using an hourly chart. Or if you want to wait for the entire filling of the SIBI, you can do that, and that will allow you to have a smaller stop loss, and you can leverage more of your account, but still keeping it within the same percentage of risk. You're not just simply saying, well, you know, I got a better fill, so therefore I'm just going to throw in 10% of my account at risk. Everything's relative, so you want to be looking at an entry point as early as this high here, which is the beginning of the touch of this low, or the bottom of the SIBI. Okay, so we have one single pass down on this sell side delivery. So our internal range liquidity is tagged right here. Why is it internal range? Because we have this swing high, we drop down. So our range is from this high down to this low, and it's retracing within that range. It's doing so on the basis that it goes above the 50% level. So now we're in a premium. So in the premium range of the PD array matrix, we are at a internal range liquidity pool. This is a pool of liquidity waiting to be utilized. Okay, institutional, not in the form of retail. What I just said to you is a stark contrast to what you learn in retail trading. Everyone in the retail capacity knows that above this old high there will be buy stops, and they run it. Those buy stops have been taken, and it goes lower. Institutionally speaking, this is a liquidity pool because it's going to provide the basis of traders that chase that market up. They're going to see all this running up, and they're going to buy into that. Buy. That's why when we see the markets fill in fair value gaps, SIBI, and BISI, they're usually filling on large, fast candles because it's injecting a mentality in the scope of retail traders that this market's on fire. It's taking off. And if you study all of the filling of fair value gaps or liquidity voids or SIBI or BISI, the hallmark signature to them filling is speed, because it's offering an enticement to traders. They're watching price. They're seeing it take off. They want confirmation. Okay, they see this low here. They may they're bullish. Maybe they think it's going to go higher. Great. And then when you start seeing this big candle tear off, okay, they're only seeing this quick sudden movement on an hourly chart, and they're thinking, wow, it's going to go above here. Well, no. You want to see the price action internally. Okay, in your mind, you want to say, okay, there's an imbalance here. Is it slowly creeping up to fill that in? Or is it quickly getting up there? If it's quickly getting up there, then you know you probably got a good trade. And it's on the basis of internal range liquidity. So right away, this shaded area here, every shaded box on this now lower time frame chart is indicating a 30 pip range. That's the basis or the framework for this model. I'm not trying to teach that you take 15 trades a week. Okay, you only need just one of them. One. If you risk 2% of your account, which is extremely high immediately, but if you get good at this and you risk 2% of your trading account, and you do a 1-for-1, you don't even need a 2-to-1 or 3-to-1. Okay, the folks that say you have to have that model gearing to be profitable, I guess you do require that if you're trading with retail stuff that just doesn't have a lot of continuity. The consistency is lacking. But when you look at price from an institutional perspective, it's very generic. It repeats itself over and over and over again. So having a model that's 1-to-1 that has a high strike rate doesn't concern me. I don't worry about that. And in fact, again, most of the things that you guys watch me do on Twitter, they're many times 1-to-1 or 1.5-to-1. Okay, where I'm not required to do multiple R's to get a profitable outcome. So just again, that's another misnomer for people that don't know what they're doing. Okay, I guess statistically those probabilities will help, but they still will blow your account if you do it over and over again with stuff that doesn't have consistency or continuity. So if we're going short here with internal range liquidity, we're exiting at external range liquidity. What would that be? Well, remember, the draw is down here. We're getting in up here. We're looking to offset at a low, below an old low. Okay, well, we have a session low here. 30 pips from entry here, 30 pips down. There you go. We have a run on liquidity. There's your 30 pips. You're done. In just a few hours, your week is done. It's over. You've met your criteria for doubling your account every single year, targeting 6% return compounded every single month. Your equity grows and doubles every single year. Start with $1,000. Theoretically, it's over $1 million in 10 years. Now, that does not consider or factor in taxation, obviously, but if you can set up your account with a tax deferment or an IRA type vehicle, you're killing it, because you're really seeing exponential growth. And that's just doing one trade. Now, if you know what you're doing and you see that we have a break-in structure here, we have a single pass down here from this candle's high to this candle's low. We have a small little fair value gap. The market will want to rebalance that. We see that happening here. And notice it does not need to go up in here. This void does not need to be filled. Why? Because we are inside of institutional order flow that has broken this session low. So this expansion down, it's only going to need what we know in retail is classic support broken is now resistance. That's when that stuff works. That's the only time that stuff works. Any other time, try doing it and see how well you do. Because if it was just that easy, everybody would be rich. Okay, everybody would be making mentorship groups and selling courses and writing books. But sadly, there isn't a whole lot of people doing that and being consistently profitable. All right, so we have another opportunity here. If we went short on the basis of rebalancing back to this low, the fair value gap is here, not seeing this as a liquidity void. A lot of folks that have studied my free stuff or went through some of the mentorship and quit, I had a guy send me an email, say, yeah, I figured it all out. I'm gonna make a go at it right now. And he's only went to month 3. Okay, I'll see you in a couple weeks. You'll be wanting to come back in. The level of entry here, again, if we're looking for 30 pips, it's only taking us down to this level here. We don't even get down to this level yet, and we still already have 30 pips in the bag. If an astute trader were looking at this, knowing that we have an entry point here, they could take 30 pips off here, fund themselves, okay? Put their stop at break even on the entry. Why? Because we've taken a first profit. You got to take the risk out of the trade at that point. You have to do it. Because you can be wrong and it can come all the way back and scream and knock you out. And what have you done? You've paid yourself for your time and risk. Now, it did not pay out what you could have seen as a maximum payout. But people that think that way are thinking about it too myopically, because you're assuming that you're going to win all the time. And that's foolish. I don't win every time. So we have to build in these quote-unquote crutches for human. The human aspect or factor in us, all of us, is going to mess it up. So when the market provides you the 30 pips, you take it. Okay? If you're growing in this model, okay, you start, say you like this model and you want to start with this one, maybe you can take 15 pips off when you get it to take that initial uneasiness off, and the 30 pips will be your full profit. And you don't do any of this down here. The next level of practicing and building in that would be taking first profit of 30 and then leaving a portion on to get down to your original terminus. The highest form would be taking an entry and then waiting for any other secondary entry and splitting the position that you started with at the initial entry. Say, for instance, that you did, just for the sake of argument, say you did one standard lot up here. Okay, so you're short one standard lot. You've taken some measure of profits off. The market trades down a little bit lower, and it comes back and gives you an opportunity. And right away, you know this is an opportunity I can get in again. You can add that same portion you took off right back here. Now, at first glance, it's going to sound like, well, why would you even want to do that? It's stupid. Why not hold it? You don't know. You don't know what it's going to do. So you want to fund yourself and then remove the risk. At this point here, you can now put the second portion back on that you just took off. Okay, original split from your profit entry here and target here. When it comes back up, it gives you another entry here. Or you can do this. Sell it here. Say you did one standard lot here. Then the market comes back up. You don't do any partials. Say you want to do a trade at this price point here and you want to use 15 pip stop loss. Okay, well, if you're getting out here on a full exit, that's a 2-to-1. If you enter here with 15 pips and then you wait for the retracement to offer another opportunity, because we haven't reached this level down here yet, or terminus, you cannot take partial profits, but you can add an additional 5 minis. 5 minis here and 1 standard here. You have 15 minis at work from this price point here. When price drops down, you have a larger position and you didn't factor in any partials. So there's several different ways you can model this for yourself and make it as, well, aggressive as you want, or you can dial it back and be as conservative as you want it to be. Okay, on the hourly chart on the left-hand side, we can see a little bit of these areas here with more refinement with the 15-minute chart on the right-hand side. We have a bearish order block after the turning point up here. Rebalancing, wait for it to break down, trades back up to here, up candles, trades right back to here, boom, there's your sell signal. Okay, we're trading inside of internal range liquidity, bearish order block. Selling short there, then we can use a stop loss right above here. So it doesn't have to be a large stop loss. So right away we can start seeing that it could be a 12 pip stop loss, which is about the standard on my low end. I don't think a 5 pip stop loss is realistic because a broker's going to open up the spread and tag you. And they can do that and try doing it and see if I'm not telling you the truth. About 12 pips is as low as I'll go. I comfortably like 15 pip stop losses if I'm going to go really tight. But I have no problem with doing 20 and 30 pip stop losses, even if the trade can be done with a tighter stop. I do so many things in a day or in the evening time. I can't be watching every tiny little tick. So I want to have some flexibility. And it's going to take a real move to knock me out. And I ain't worried about it if it does. But we can see the bearish order block here and then a nice run below the short-term low. Volume imbalance. See that right there? No candle. Body. Price comes right back up, rebalances at that point. That could be your initial entry, or we can use the bearish order block. Once price starts to show a breakdown, come right back up, bearish order block. Probabilities of you missing this trade is considerable if you're waiting for that. This is the ideal entry, but if you're looking for order blocks to be your basis, there you go. Your internal range liquidity entry point is there. Again, from this entry, at this old low, volume imbalance, entering here, 30 pips takes you here. You're taking your profit right on this candle at 30 pips. We have another one in here. We have a single pass with this down close candle. The next candle's high is here. So we have a fair value gap right in here. Price fills it. You can sell it there. And 30 pips down here. And the problem with this last one is you may not have gotten out with the spread. In fact, it's very likely that you never got out, even though it went to terminus. So when it trades down to these levels, this is why you want to be taking consideration with exiting ahead of the level. So even though this does breach the low, and it does breach that old daily low and the low that was on the weekly, by 1 pip it does this. Check your own data and you'll see. This is enough to warrant an exit. The fact that we're trading down to it, I would already be out of there 10 or 15 pips above it. So in other words, if I see that level here, 10 or 15 pips, I'm up here getting out. Because I'm not trying to be Mr. Wizard, okay, and try to get every piece of the pie. Look, gorging yourself with all the sugar is going to make you unhealthy and fat. And I don't want to be unhealthy as a trader. I want the lean, real high calorie, high protein, high density nutrition okay, from the pounds of flesh that I take out of the marketplace. I don't want junk food, okay? And the sweet tooth that everybody gets wanting to be the lowest entry and exits on their turns, that's just, to me, I wasted a lot of time doing that. And my exit strategy is always taking something ahead of the level. Now, I may leave something on that may get stopped out or never come to an exit, and I just got to bail on it without being stopped or reaching my target. You've seen a lot of that in the Twitter. So there's some balancing act that takes place all the time. If I know that level down here, okay, is that old daily low, I know everyone sees that same level. And I don't want to be down there trying to get my order executed when everybody else is rushing to get theirs too. Because price may not spend a lot of time down there. But as it's approaching that, if I'm exiting as it's sliding into home plate, okay, I don't care. I'm getting out. I'll take a triple. I don't need to get a grand slam home run. I don't need to, run all the bases and get home on my single swing. I want to be able to be consistent, okay? And consistency is not always hitting home runs. A double, a triple, a lot of singles in a row still builds your equity. But you don't need the home run analysis payoff. You don't need that. And this model is to teach you that if you have 30 pips in mind, you take those 30 pips when it gives it to you, pay yourself, remove the risk, and then see what happens. But if it gets close to that terminus, just know that because of the capacity of the data we work within, it's all retail. Okay, so Interbank is never really agreeing with 90% of the retail brokers. There's some measure of spread between the time and the price. So just know that that's what you're dealing with all the time. And because I know that, I'm always getting out 10 to 15 pips ahead of the levels that I'm looking for. And I'm okay with that. It may not look as precise, if you look at the ledger, but the consistency's there because I deal with that same element every time I take a trade. If I know a hard level's in the marketplace, I'm targeting, I want to be out as it's sliding in the bulk of my position. I want to be out of that. And then I'll leave a little tracer in there to see if I can get something else, a little leader in the water, if you will. And if I can catch a runner, then I have something to appease that gambler in me. Okay? Because you got to keep him at bay. And if you give him a little bit of action, okay, to me, at least it's for me, it's helped over the years. Otherwise, I want to do a lot more. And because it's been spurred on by me not holding for my original targets or beyond. So that's how I balance the three people in my head: the analyst, the trader, and the gambler. So we looked at this model, and right away you're probably thinking, well, this is not a whole lot of new things. And that's supposed to be happening. You're all charter members. I want you to go through all of the currency pairs from last week, okay, and use this model as a basis and study it. Just this past week's data, okay? Look at what you've had available to you. You've learned a great deal about fair value gaps, BISI and SIBI in the last couple of weeks, consequent encroachment, when a certain fair value gap is to be considered. You've learned now, obviously, when a void is not to be considered, okay? When we look at those factors, it builds a lot of context to what we are looking for in price action. And slowly but surely, all of you have been moving from a neophyte to where you are right now. And it's normal for you to still feel a little bit of apprehension about getting in there and saying, oh, I know what I'm doing right now. Because there's models still being delivered. We haven't even broken them down into a trading plan yet. These are all just simple price action models to start looking to see what it is that you want to do with your trading. And then you will gravitate to one. If this model doesn't tickle your fancy, some of the elements I gave you in this model might help spur on the inspiration to create your own model that would be very close to this. The number one contributing signature in all my setups is basically a draw on liquidity. I want to know where the market's going to reach for because I know how institutions work and I know what IPTA is trying to do. If whatever model you build or agree on, Okay, you may subscribe to one of the ones I'm providing you, or it may not be any of those things, but they may be inspirations off of them. You're going to find that the underlying theme is we're trying to predict where price is going to go on the basis of liquidity, not on the basis of price patterns. We're not trying to do measure moves. We're not trying to do Fibonacci's. We're not trying to do harmonic patterns. We're not trying to do supply and demand. We're not trying to do any classical retail theory at all. All we're doing is saying, what's the largest probability right now? Is it to move higher or lower? And if you apply that to a weekly chart, you've already factored in the biggest odds in your favor, because if that weekly chart is going to move in the direction you're saying, 50 to 100 pips, that's where, if you look at all of your losing trades, many of them are going to be in a contrarian stance to that. Now, obviously, you have the benefit of hindsight. Go back and look at that. So it is important that all of our analysis starts on that. Now, I could do a lot of different things on a lower time frame chart and never even factor a weekly chart. And I can do a lot of things and not even refer to the weekly chart. But I'm teaching you as a mentor to do this with high probability. The only way that probability becomes a realization in your trading is when you look for that weekly chart to move. Because it's such a large time frame, it spends a lot of time moving in that direction because it's a weekly chart. The ranges are going to be larger. And since the ranges are going to be larger, institutions are not trying to get these 20 pip runs that you see me doing. I'm just taking small little surgical strikes out of the larger move that I'm using with this model here. Okay, so if that weekly chart is going to displace 50 to 100 pips, that's more meaningful for institutions to work with them, because that is, well, the easiest way to say it is there's enough movement for them to find profitability in that versus a 20 pip move or 15 pip intraday scalp. They don't have enough flexibility to move their size through that. But 50 to 100 pips, they can move size inside of that. And it's important that you know that half a penny to a full penny move is, in my opinion, and I don't really have any statistics except for my own experience to back this up, that's about the minimum threshold for institutional displacement. So if we see a 50 pip move, higher or lower, you know there's institutions involved. Now, if it's going to move 50 to 100 pips to a liquidity pool that can be targeted easily relative to a daily and weekly chart, it's a loaded deal. It's a loaded deal, and you know how to use it now. So bias, directional bias, starts on that basis, and probabilities are formed on that. So hopefully you got this model, and you see here on the kill zones that the overlapping of the setups occur during these specific times of the day: Asia, London, New York, trading to a specific price level. So we understand here in this mentorship, there is a time and price theory. Nothing happens randomly. The market is going to draw where there are orders. What orders? The orders that allow offset distribution that would be profitable for the most recent displacement. In other words, if the market has moved from a higher level down lower, it's going to a specific level to offer liquidity for those individuals that have allowed price to move in their favor going lower. It's going to attack an old low, or it's going to go down to an internal range liquidity pool in the form of a lower level fair value gap, lower level liquidity void, or it's going to a bullish order block. And the reverse is said when it's bullish. So hopefully you found this insightful. Until I talk to you next time, wish you good luck and good trading.